How's it going, guys? Welcome to another video. We're going to be going over the most anticipating earnings for next week, as well as the stocks that you guys should be watching for earnings. It's going to be a pretty volatile week. As you can see on our screen here, tons and tons of companies are reporting their earnings. And we also have a ton of big tech names, including Microsoft, Intel, Apple, and even Tesla. So be careful next week. Market is kind of shaky. A lot of stocks are in the red, so we're going to be very careful this upcoming earnings. We're not going to be doing anything crazy. And if you own shares of these companies, you might want to sell some covered calls just because of how uncertainty the market is right now. So first off on the list is going to be Apple reporting earnings Thursday after the market closes. And as we can see, Apple's been doing pretty well. Of course, it's down quite a bit in the past week. All-time highs around $182 per share, so it's down. It's pulled back around $20 in the share price. But yeah, Apple, even though this market's kind of in a bear market right now, Apple's been holding its ground. It's a very solid stock. I'm always going to be continuously dollar cost averaging into Apple, and it does pay a dividend of 0.5, so that is a nice added bonus, whereas a lot of these other tech companies don't offer dividends. So next up on our list is going to be Robinhood stock. And as we can see on our screen here, it's been getting killed ever since it IPO'd back in July. All-time highs of this stock was around $85 per share. So this stock has pulled back incredibly. It's getting killed. So a lot of shareholders of Robinhood stock are losing a ton of money. But eventually, I do think that this is going to rebound. I know that Kathy of ARK Invest is continuously adding more and more shares, as you can see by this purple line, continuously buying these dips. Crypto wallets are coming out pretty soon for Robinhood platform, which is going to be pretty huge. And once that does roll out, I think that a lot of people will flock back to this platform. I still use Robinhood, and I know a lot of people use Robinhood as well, just because of how simple the user interface is. So now could be a pretty good time to buy some shares of Robinhood, or if you want to sell some put options, you can do that as well. Selling maybe February 4th expiration date, and we want to go pretty far. We don't want to take too much risk. You do a $10 cashier put for February 4th, or even a $9, and that's going to be over an 80% chance of profit, and you're going to be collecting a lot of premium. There's tons and tons of premiums on put options right now just because people are so scared. They're buying put options to hedge. The bear market's not going to last forever, so selling some put options every now and then can be pretty good, especially right now when implied volatility is high, meaning the premiums are going to be high as well. Next stock on the list is going to be Tesla reporting earnings Wednesday after the market closes. As you can see, it's pulled back quite a bit as well. All-time highs for the stock is around $1,200. So it's pulled back around $300 per share. Now could be a pretty good buying opportunity. I think buying Tesla under 1,000 personally is a good deal. So right now, buying Tesla, and you just want to buy and hold for long term. Of course, the stock is pretty expensive at almost $1,000 per share. So just dollar cost average when you can. And you should see some pretty nice returns as the stock is up 1,800% in the past 5 years. Next stock on our list is going to be Microsoft reporting earnings Tuesday after the market closes, as we can see here, and this stock has pulled back quite a bit as well. It's held its ground pretty well, like Apple. Apple and Microsoft are some pretty big tech companies. It's a safe bet to just invest into it. I'm going to be buying some more Microsoft shares into my Roth IRA. I think this pullback is a pretty good dip buying opportunity in my opinion. And Microsoft also pays out a dividend of 0.78, so nice little added bonus right there. Next stock on our list is going to be Boeing. This is going to be a bit of a recovery play, especially with the airlines being kind of shaky. But Boeing, if it can return back to its pre-pandemic highs of around $300 per share, you're seeing a pretty nice increase in stock price, a 50% gain. So I think it definitely can in the long run. This is a buy and hold, and yeah, just buying and holding and waiting for the pandemic to end. And then the price of Boeing will definitely recover back to its pre-pandemic highs. So next up on our list is going to be Intel reporting earnings. Let's see, reporting earnings Wednesday after the market closes. Intel is a nice dividend stock as well, 2.67% dividend yield, and it's a pretty good stock. It doesn't move too much, it's not very volatile, so it's a pretty safe bet to just buy and hold some shares, let those dividends reinvest, and compound interest grow your account. So I might be picking up some shares of Intel into my Roth IRA. And then last but not least, another dividend stock. It's going to be AT&T. Pretty wild. Recently with the volatility with AT&T stock going all the way to $22 per share before rebounding back to 27, and then settling around the $26 share price. But if we take a look at the dividend yield, pays out almost an 8% dividend yield. Earlier in the year, it was cut from, it used to be around 10% dividend yield, but now it's only 8%. But that's not bad because they also pay out for some pretty high dividends for a stock. And it's one of people's favorite dividend stocks just because of how high the dividend is. And this stock pays out quarterly, which is pretty nice as well. But if this stock can recover back to its pre-pandemic highs of $38 per share, we're going to be seeing some pretty nice gains in the long run, especially with 5G rolling out. AT&T should do pretty well. So that's about it for this video. About 7 stocks that we're watching for earnings. We're not been doing anything crazy. You could sell some cash care puts on these stocks if you want to own some shares, or you could just buy shares on this dip. Honestly, the market's pretty red, and what better time to buy when the market's red? But of course, you don't want to throw all your money in at once. You want to slowly dollar cost average into these stocks in case the stocks continue dipping. And then you can continuously buy these dips. As long as you're investing into solid companies, such as the ones we mentioned here, you should do pretty fine as long as your goal is to invest for long term. So that's about it for this video. Thanks for watching.